So, if there's been one company that has given investors the most headaches over the past few years, that company is without a doubt Intel. The stock overall is down about 67% since it peaked in mid 2021, and it's down for good reason because the business hasn't been doing very well lately. Revenue is down with just 55 billion in revenue over the past 12 months. Profits are down so much to the point where the company is actually losing money, and the Intel foundry is burning about $2.5 billion per quarter, primarily due to the low volume and low average selling prices because it's producing technologically uncompetitive chips. Now compare this to 2020 where Intel had 77 billion revenue at a 30% operating margin and made about 21 billion in profit. So some investors are even calling Intel the worst managed company in the US, with Boeing being the only one that's probably worse. And they just released their Q2 earnings a few days ago, which was far worse than any investors had anticipated. There were many bad things to come out of this report, but probably the two worst things that they said was one, that they're suspending the dividend for the next quarter, and two, that they're looking to slash up to 15% of their entire global workforce just months after the US government announced that they are giving them close to $10 billion, presumably to stimulate job growth in the US, which is obviously a terrible look for Intel. So now the sentiment surrounding Intel is as bad as ever. But remember, money is made in investing by going against the census. Be greedy when others are fearful is the classic saying. Now, this doesn't mean just drop everything you're doing and go and buy Intel right now just because it went down a lot recently. But personally, I think it is worth taking an objective look into the company. So that's what the goal of this video is going to be. Let's take a look at Intel with a more long-term view in light of this recent earnings report. The reality of the semiconductor business is that it operates with a lag. Decisions that the company is making now won't really be reflected in their financial results until about 1 to 2 years down the line. So it's all about understanding what's coming in the future. Now, Intel has, without a doubt, made some strategic missteps over the years, and it really all started in 2017 when AMD launched their Ryzen chips, which were initially manufactured by a company called Global Foundries, which was actually spun out of AMD themselves in 2009. And TSMC, the world's largest pure foundry business, began mass producing more technologically advanced chips as Intel struggled to keep pace with the rate of innovation after having a so-called technological lead over them for over 2 decades. And then in 2019, AMD began utilizing TSMC for their Ryzen 3000 series CPUs, which were on par with Intel's offerings and allowed them to take significant market share away from Intel. Meanwhile, TSMC severely passed Intel's manufacturing capabilities and started signing major clients like Nvidia, AMD, and the biggest one of all, Apple. So ultimately, it was poor management and Intel just taking far too long to upgrade their manufacturing capabilities that led to all the problems that we're seeing with Intel now. And again, this just highlights the nature of the semiconductor business. It's all about understanding who has a current technological lead and what's coming in the future. Looking at historical metrics like PE ratios or historical profit margins doesn't really tell you much. It doesn't really explain why a company is valued the way that it is. And this is why I think so many investors got value trapped by Intel, because it seemed like a high quality company with very good margins that was trading at a single digit PE ratio. But if you don't understand the dynamics of the semiconductor market, then you're setting yourself up for a disaster. Despite all of this, there's no doubt that the Intel foundry is one of the most important strategic assets on US soil in the semiconductor industry, which is an industry that is proving to be critical not just from a technological advancement perspective, but also for national security in the United States. So what I want to do in this video is give a brief overview of the semiconductor industry and talk about who the main players in this industry are, and then talk about some of the recent developments that we're seeing in this industry, such as the CHIPS Act, and then get into Intel specifically. So without further ado, let's just dive right in. So semiconductors have become the backbone of modern technology. The biggest markets for semiconductors worldwide would include things like consumer electronics, so laptops, PCs, smartphones, tablets. You also have data center products like servers. You have the automotive market, and with the rise of electric cars, this is becoming an increasingly larger market. Medical devices, telecom equipment, you get the idea. And as we've seen over the past 2 years, investment into generative AI and large language models has become a new catalyst for demand, specifically for GPUs. There's many different types of semiconductors, but the two I'll be focusing on in this video are CPUs and GPUs. CPUs are like the brain of the computer that is very good at handling general tasks, while GPUs are more specialized for certain compute-heavy tasks like video games, simulations, machine learning, etc. Now, the top five most important semiconductor businesses worldwide, in no particular order, are Intel, AMD, TSMC, Nvidia, and Samsung. Now, with Intel, the easiest way to think about Intel's business is having two distinct parts, chip design and chip manufacturing. And this is called the Integrative Device Manufacturing Model, or IDM model. The pros of this model is that Intel has more control over their manufacturing and they can, in theory, get products to market faster than companies who outsource their manufacturing to a company like TSMC, for example. The cons of this is that it requires a lot of investment to maintain and continually improve these foundries. And this is really the cost of doing business for Intel. And its founders even knew this was going to be the case in the early days of the company. One of Intel's co-founders, Gordon Moore, who is famous for creating Moore's Law in the 1960s, which was really more of a prediction than a law, but he predicted the number of transistors on a microchip would double approximately every 2 years. And higher transistor density means better computing power and efficiency. So more technologically advanced chips generally means higher transistor density. And this has generally held true over the years, but it does mean that the complexity of semiconductor manufacturing also rises each year. So the capital investment will always be high, but ideally, these facilities can produce a large volume of chips at high enough selling prices, leveraging economies of scale to reduce the average cost per chip and make it a profitable business. Now, for a period of roughly 30 years, Intel was the most dominant chip company, so much so, in fact, that they actually faced accusations of being a monopoly. They produced the most technologically advanced chips and had a comfortable lead over competitors like AMD and TSMC. Their biggest customers were Apple, who started using Intel in 2005 for their computers, and as we saw the growth of the cloud computing market, companies like Amazon, Google, and Microsoft also became major Intel customers. But in 2020, Apple announced that they would no longer be using Intel, which was really the start of their downfall. Now, Intel was still the leader with chip manufacturing, and NM means nanometers, which just refers to the size of the transistors on a chip. And remember from Moore's Law, higher transistor density for semiconductors means better computing power and efficiency and overall technologically more advanced chips. But then TSMC caught up and had a foundry that could make 7 nanometer chips, which were more technologically advanced than Intel. And it took Intel too long to catch up with their own 7 nanometer capabilities, and ultimately they fell behind TSMC. Intel couldn't transition to 7 nanometer until 2022, and still to this day they haven't introduced 5 nanometer, while TSMC had introduced 7 nanometer by 2018, 5 nanometer by 2020, and 3 nanometer by 2022. And so AMD began utilizing TSMC to produce their Ryzen CPUs in 2019, which offered better price for performance than Intel, which allowed them to gain market share. But even despite Intel's missteps, they still enjoy roughly 63% market share of the CPU market, while AMD owns 33% of this market. Now, it may seem odd that Intel still dominates the CPU market over AMD, but there are a few reasons for this. And one of the reasons is just pure brand loyalty. Many OEMs like HP, Lenovo, and Dell that put CPUs inside of their computers have been using Intel for years, and they've built long-standing relationships with them. And another is product availability. Intel's large-scale manufacturing ensures that they will always have product on hand, which especially appeals to enterprise customers who generally prefer things like stability that Intel brings, as opposed to having the most cutting edge technology out there that they could get with AMD, for example. Now, Intel does also offer GPUs, as they recently introduced their Intel Arc GPU in 2022, but their share of this market is minuscule compared to AMD and Nvidia. Now, Intel is also releasing the Gaudi 3 GPU later this year, which is expected to be on par with Nvidia's H100 GPU, but this is really too little too late for them because Nvidia and AMD already dominate this market, and for Intel, GPU sales won't really make up for the losses in their foundry business. So now let's talk about AMD for a little bit. So AMD is solely a chip designer. They operate using the so-called fabless model, which means they outsource their manufacturing to companies like TSMC, and they make both GPUs and CPUs. Now, AMD for a long time was nowhere near being a threat to Intel. About 10 years ago, there were real discussions about AMD potentially going bankrupt, but this all changed in 2017 when they introduced their Zen architecture. And this new form of chip design was a significant improvement for them and almost instantly allowed them to be competitive with Intel's chips. And after years of reporting losses and stagnating revenue, things started to turn around for AMD. And then in the coming years, 2018 to 2024, revenue would quadruple and profits would go from zero into the billions. AMD is currently valued at $230 billion, while Intel is valued at just $96 billion, despite Intel having almost 2 times as much revenue as AMD. And the reason for this massive disparity is because AMD is a big player in the GPU market, and GPUs are needed to power generative AI models. And we're seeing massive investment into this from big tech companies. Just this past week, Microsoft reported having huge capex investment specifically for this reason, and Meta also reported their earnings and said essentially the same thing is coming for them in the future. Now, of course, the king of the GPU market right now is Nvidia. They own roughly 88% of this market, but AMD is in second with a market share of about 12%. And when you're talking about a market that is expected to be worth somewhere between $200 and $400 billion in about 5 years' time, lots of growth is expected from these companies. And Intel didn't make the decision to prioritize GPUs a few years ago to capture some of this trend, which is now ultimately hurting them. Now, what's important to understand about the semiconductor industry is that it is a cyclical industry. Demand for semiconductor products ultimately depends on demand from end customers, whether it is consumers purchasing electronics, it could be telecom investing in 5G, it could be big tech investing in AI. Demand ultimately has to come from some end customer, and these end customers are subject to things changing in the economy, which can influence their purchasing behavior. For example, when interest rates go up, debt is now more expensive for companies, so there's less financing options available for them, which means companies that invest in things like data centers may hold off on those investments, or they may decide to just not make them altogether. So the companies that own and operate these foundries that produce these chips for the global markets have a huge opportunity in front of them. And just to reiterate, the biggest foundries in the world currently are TSMC, Samsung, and Intel. These are the three big companies that make vast majority of all semiconductors for the world. And it's probably going to stay this way for a long time because building a new foundry that's on par with these existing foundries is estimated to cost at least $30 billion and would probably take close to 10 years to complete. And by that point, Intel and TSMC have probably already established an even greater technological lead. So it's just far too substantial of an investment for pretty much anyone to consider making. Which brings us to the CHIPS Act. This act was passed by the Biden administration in 2022 with the goal of providing funding and tax breaks to foundries on US soil to expand their manufacturing capabilities. Basically, the US government recognized that being technologically inferior to foreign companies was not ideal, and Intel, despite all of their shortcomings, was still the most technologically advanced foundry that was also a US company. And Intel is already starting to build new foundries in Arizona and Ohio. So the CHIPS Act can really help Intel try and close the gap with TSMC and Samsung and also ensure that the US doesn't need to rely on foreign companies to supply what is arguably the most important piece of technology for the modern world. And even though Samsung and TSMC also have foundries on US soil and also received funding under the CHIPS Act, the US government will likely prioritize Intel simply because it's a US company. But as it stands currently, this foundry is running massive losses. It's losing about $2.5 billion per quarter, and the company overall is losing money. And this is just simply because their products aren't technologically competitive anymore, which means their production volume and average selling prices per chip are lower. And it's hard to operate a profitable foundry under those conditions. So, in order for Intel to reverse course and become successful once again, these things have to change. Now, when Pat Gelsinger became the new CEO back in 2020, he introduced a new plan which was called IDM 2.0, and this plan had three major goals. One was to expand and improve manufacturing capacity. Two was to expand the use of external foundries when necessary, like TSMC, for example, to make Intel chips more technologically advanced than Intel themselves are currently capable of, which is something that's happening right now. Intel does use TSMC to make some of their chips so that they can at least be a little bit competitive in certain areas. And then part three was to become the number two foundry behind TSMC by the year 2030. He also introduced the 5 nodes in 4 years plan in July of 2021, and each node of this plan represents progressively more advanced manufacturing technology. And remember before from Moore's law, transistor density should be cut in half approximately every 2 years. And the 5 nodes of this plan are the Intel 7, which was introduced in 2021, Intel 4, which started production in mid 2023, Intel 3, which started production in late 2023 and is where they're currently at with their plan, and then Intel 20A and 18A. And they're expected to ramp up 20A production later this year and then begin producing 18A by mid 2025. And for reference, 18A is 1.8 nanometer transistor density. The TSMC foundry is currently producing 3 nanometer chips as their most technologically advanced. So if Intel can actually execute on this plan, then they could reliably be just slightly behind TSMC by the year 2025. Now, obviously, that is a pretty big if, and right now investors have pretty much zero confidence in management's ability to actually do what they say they're going to do and execute on any sort of plan that they tell investors, and they are going to face massive upfront costs in rolling this thing out. But if all goes according to plan and manufacturing volume increases, then we should see a gradual expansion in operating margins and net income for Intel in the future years beyond 2025. In fact, they already have some future customers booked, with Microsoft being the most notable one with a deal value that's expected to be worth $15 billion. Now let's talk about what products Intel is going to come out with over the next few years, because like I said at the beginning of this video, understanding what products are coming out in the future and how those stack up to the competitors is key to understanding any semiconductor company. So Intel is coming out with a few new chips that are being manufactured by TSMC using their 3 nanometer technology. And ultimately, Intel had to make the decision to use a more advanced foundry to make more competitive products. And these products are expected to be just as good, if not better, than AMD CPUs. For one, you have the Arrow Lake CPUs, which are expected to come out later in 2024. There's also the Lunar Lake CPUs, part of their so-called AI PC product line, which are more designed for notebooks and tablets and give them artificial intelligence capabilities, which are expected to come out next month and will offer 50% better graphics performance and 40% more power efficiency versus the prior generation. And as the volume of these products starts to ramp up, so will Intel's revenue and margins, since they're now offering more technologically competitive chips, which allows them to have more volume and sell at higher average selling prices, which should ideally make those massive foundry losses look a lot less severe. And Intel also has a new data center CPU coming out. Namely, there is the Sierra Forest and Granite Rapids, and then there's also the Intel Clearwater Forest data center CPU, which is expected to be released sometime in 2025 and uses their 18A manufacturing capabilities, which should be competitive with AMD's offerings by then. And if interest rates are lower by then, data center investment as a whole should pick back up, which should stimulate demand for these chips. So all of this indicates that the biggest issue for Intel right now is the foundry and how much money it's losing. So the key for Intel going forward will be getting 18A into production on time and on schedule. This will make them competitive once again and allow them to win new customers like they did with that $15 billion Microsoft deal. If they screw up 18A, then the foundry will be stuck making uneconomical units selling for low prices, and the losses could get even bigger from where they are currently. Now, I don't necessarily think that bankruptcy is on the table for Intel, since they do have the backing of the US government, but for you as a shareholder to see some decent returns, Intel can't afford to see more delays in this. So Intel's path to recovery is by no means a certainty. It's going to be extremely capital intensive and take at least a full year before you start to see any real improvement in their actual financial results. But believe it or not, there is a reality that exists for them where coming out of the year 2025, we could start to see some improvements and they can be competitive with other companies once again. The reality is that at this company's current valuation of $96 billion, you don't need them to become the number one foundry again because there's just so much pessimism that's already been priced in. But if we continue to see more delays in them upgrading their manufacturing technology, they don't capitalize on this massive AI trend that's happening right now, and they can't develop a strong GPU product. And if management keeps telling us the same story over and over, which is things are bad now, but just wait 1 or 2 years and we'll introduce some new plan and things are going to get a lot better in the future. Until those things start to happen and Intel can actually prove to investors with real financial results that things are actually getting better, then I wouldn't expect to see any recovery. So that pretty much does it for this video, guys. So thank you so much for watching. For those who are new to the channel, I just want to quickly mention that I do have a website that I created called Tickernomics.com. This is a website that's designed to help retail investors analyze companies from the perspective of a value investor. So we have financial statements available here. We have ratios, there's charts as well, and we also have a DCF feature, which allows you to enter companies and play with your assumptions to get a rough estimate of what you think one share of a given company could be worth depending on your assumptions. We also have a scripts library, which allows you to search through custom lists of different types of companies. So if you are interested in those kinds of things, link is in the description, so feel free to check it out. But yeah, thank you so much for listening to this video, and I'll see you guys in the next one.